Hey, good morning, everyone. Marty Missouri here, the 13th of April, 2025. Folks, going through my weekend exercises, updating our charts, the data we track, etc. A few things that I want to share with you that come from our own financial stress index. I want to share a few of the inputs to that index, and clients help you continue to appreciate or understand why we continue to sing a cautious tune right here, continue to hedge your portfolio, continue to stay pretty liquid, and continue to stay uber diversified right here. There will come a time for certain that we will be able to take on or be willing to take on more risk. But right now, the overall macro backdrop, valuations, state of geopolitical affairs, et cetera, continue to have us treading somewhat cautiously. So let's first talk about the news late Friday after the market closed that the administration has decided to exclude tariffs on computers, on computer chips, on smartphones, on computer chip making equipment, and probably a few other items. That's going to be a really big deal, I think, at least at the open tomorrow morning, Monday, which is when you clients will be receiving the link to this video in your email. But I want you to think about it within the context that I keep talking about, that if indeed this does turn out to be what we would call a bear market, which remains our base case right here. Of course, very willing to change that base case with new data, new information, but right now, nothing so far has suggested that we need to abandon the notion or abandon the expression in the portfolio that, bear market is something with odds too high to ignore right here. So again, though, with these bear markets, we get these bear market rallies. I've illustrated that for you. I want to touch base on it again today just to remind you that it's probably not the kind of situation that we want to chase in terms of these rallies. And then at the same time, we're recognizing that who knows, maybe indeed the bottom is in. I suspect that perhaps a bottom is in for the near term. It would not surprise me to go a few days and a few weeks in sort of a counter-trend rally fashion, which is also consistent with past bear markets. The concern, the overriding concern, is just the data going forward and what we think is going to happen. The soft data is rolling over. It tends to lead to hard data rolling over. Now, granted, if suddenly more of this trade war concern were to dry up and bring animal spirits back in force, it could delay what we think is an inevitable recession. We still do believe that the economy is cyclical. Problem with the delay and problem with not having a recession sooner than later is that we won't cure the ills that come with excesses in the economy. Remember the gargantuan amount of stimulus that is still to some degree working its way through the economy. Remember the inflation that comes with that. If we do not clear markets, purge some of these excesses, inflation will come screaming back. So we need to be aware of an early 80s type scenario. We had, huge inflation, hugely high interest rates in the late 70s. Paul Volcker, Fed chairman at the time, raised interest rates to, I think, nearly 20% in 1980. Killed inflation, but killed the economy. As the economy rolled over, they panicked. They cut interest rates aggressively. Inflation came screaming back. They had to turn right around and start hiking rates again. Killed inflation, killed the economy again, but they had to let that 1981 recession play itself out. Of course, it didn't come without a notable amount of pain in markets, etc. But it did do the job, and plus we were entering a whole new era. I call it a capital-friendly era around Reagan and Thatcher and so on, that these regimes tend to run for decades. We're now actually reverting back to a labor-friendly environment, which is more inflationary, less productivity gains and so forth. It's defined by populism. But nevertheless, we could have a similar kind of chain of events as we did in that first Reagan term. That is where the economy rolled over amid sticky inflation. The Fed might react. Certainly fiscally, we could react. Right now, I would say the fiscal engine probably carries much more weight on the economy than the monetary engine, and the fiscal engine being essentially the government applying stimulus to the economy, as opposed to the Fed cutting interest rates and doing quantitative easing. That lever is experiencing very much, I think, the law of diminishing returns, or it will going forward. And so suddenly we move into what you might call a fiscal dominant type of situation. And I also wanted to circle back and talk again about the change that was made just before the change with electronics, and that was lowering everybody except China to 10% across the board tariffs, China up to 125%, and I guess the next day up to 145%. By lowering everybody else to 10%, effectively what they are allowing to happen is a rerouting of Chinese goods through other countries, i.e. China exports to Vietnam, Vietnam exports to the U.S. under a much lower tariff. So China can send its goods to other ports. Now, that doesn't come without a cost, having to reroute your products to their destinations. So it's less tariff, but there's still increased cost. And these are costs that are going to have to be borne to some extent, if not all extent, by the consumer, particularly when the dollar has been going down this year. Typically, the tariffing country gets to see a boost in their currency because the tariffed countries actually see currency depreciation, if not manufacture it themselves. That offsets the effect of the tariff. This is the worst of both worlds. We're not getting that rise in the dollar, at least not so far, alongside the tariff. So it actually exacerbates it. It makes things even more expensive on top of the tariff. So why would that be? Well, there's lots of theories out there. One would be that China, for example, is unloading some of their treasuries. That may or may not be the case, perhaps to some degree. Japan actually announced this weekend that they're not interested in using that as a negotiation tool, meaning they're not interested in selling down their treasury portfolio to inspire the U.S. to negotiate a little more in Japan's favor. They said that's just not something that they think they want to do. They want to remain friendly with the U.S. What we have seen this year, particularly at the beginning of the year, and this is something we've been talking about for quite some time, and that is a rotation away from U.S. assets, U.S. equities in particular. Something like 70 cents on every dollar that's flowed to the U.S. equity market the past few years has been from a foreign investor. And folks, that speaks to the trade deficit. Remember, we've talked about this a lot, and that is that a trade deficit equates to a capital account surplus. So the dollars that aren't spent on U.S. goods and services are spent on U.S. assets. And make no mistake, those Mag 7 stocks we've been talking about the last few years are hugely sitting in the portfolios of sovereign wealth funds in other countries, other institutional investors outside the U.S., individuals and so forth. Those have been getting sold aggressively, and a lot of that money's been flowing to other markets. At one point this year, our core was doing so well because the European exposure, which we definitely have a notable portion in, was up like 15% year to date when the S&P 500 was actually negative year to date. So that rotation speaks to what I've been showing you now for at least a year, if not two, and that's a record valuation gap between U.S. equities, for example, and the rest of the world. So any doubt about American exceptionalism, if you will, or whatever you want to call it going forward, that has the world repatriating back to their home currencies, money that they had sitting in U.S. stocks, could do quite the number on the market. So also keep that in mind too, investors. If we do succeed at notably lowering the trade deficit, that actually lowers the capital that can flow to markets. So it's not uncomplicated. It's not remotely easy to figure all this out. There are so many moving parts, and there are many layers below the surface layer that pretty much all people are hearing about in their chosen media outlets. There are knock-on effects that we could get into for hours probably. I'm not judging it politically. I'm not saying it should or should not be done. I'm not saying that at all. I am just on our client's behalf. We as a firm, I should say, are just assessing conditions, looking at probabilities, and allocating toward what we believe are the best risk-reward setups and paying very close attention to risk right here. Okay, so that's the S&P 500 chart. We're going to get to that. I also wanted to pull up one more here just to kind of punctuate our concerns over the economy. And so, of course, being a consumer-driven economy, in terms of the soft data, we want to pay very close attention to consumer confidence. So here is the conference boards at the top and the University of Michigan's at the bottom, and you can see the downtrend there. University of Michigan came out last week and utterly plummeted. This is as bad as it's ever been in terms of consumer sentiment going forward. So if consumers really feel that bad about their state of affairs, they're probably not going to be spending as much going forward. Now, there could be an event or events that cause those animal spirits to come back and people can get out there again. But right now, this, as you can see, these red shaded areas are recessions. You can see what tends to happen when consumer confidence rolls over like that. Doesn't mean it has to happen this time. It's just what tends to happen. Okay, so with regard to those inputs to our financial stress index, the 2-year Treasury yield compared to the Fed funds rate, it is considered a indicator of where Fed funds are going. Now, when the Fed is aggressively cutting rates, that's because the economy is waning and slowing. So typically when the 2-year rolls over like this, the Fed follows, but what also follows is typically or very often recession. That's those rate shaded areas. Not every time. You can see the yellow shaded areas. But when it does it like this, and it's looking like it now, we need to be thinking seriously about a coming recession. The high yield spread is the difference between the yield in a 10-year junk bond or the 10-year junk bond index and 10-year treasuries. When this is rising, that suggests that there is risk of default, or the risk of default is rising. Therefore, investors demand more for what they get from risky bonds. And you can see it's dramatically moving in the wrong direction. You compare that historically to what the stock market tends to do during those periods. This was a 27% sell-off, 35, 20, 16, 20, 60, 50. You want to be cautious, or you want to be paying attention when the high yield spread begins to spike. The MOVE index measures volatility among U.S. Treasuries and options on U.S. Treasuries. It's kind of like the VIX for stocks. When it's going up, that suggests that there's stress in the system, and you can see what the stock market tends to do. I've shaded these areas, and you can see it tends to be a very volatile market when that MOVE index is above 100. A measurement of liquidity in the Treasury market, the Treasury Liquidity Index, when it's above 2, it's kind of in that danger zone. It doesn't get there very often, but when it does, we see lots of volatility in the stock market. Investment grade credit default swap spreads, cost of insuring against default, shaded the areas here when it gets above 80, which is quite high historically, and you can see what the stock market tends to do. It tends to get very, very volatile and typically in the wrong direction when CDS spreads are that high. Bank of America, Merrill Lynch, they do a financial stress index. This is very market-based, and it has shot way, way above zero. And zero is kind of that danger point there when financial conditions are tightening. Again, these are all market-based. They have what they call their liquidity stress index. And again, that's just showing you that these are times when it gets above zero that you need to be cautious in the stock market. And you can see it's shot straight up this way. So potential lack of liquidity in the investment space. And then the overall market risk index. You can see when it gets above zero, it's a time historically when the equity market tends to be suffering. So as for the technicals, again, folks, intraday, it hit the textbook definition of minus 20% from the peak. It didn't close there. This doesn't really fit our definition, but I've been calling it that because of overall macro conditions and economic conditions and what our own indicators and those of the people we pay for their research are telling us. So we're acting as if this is a bear market, but willing to change our minds when the data instruct us to. But notice that, and this has been so swift. And again, we're in a heavily leveraged market, so everything is going to come swiftly and more exaggerated. So no sooner did we hit that intraday bear market level by the textbook definition, and within 3 days we had retraced 50% of it. Thursday gave some back, Friday it was strong, and Monday is set up to be strong based on the news on tariffs on late Friday. So we'll see. Recall that we did this together before, and one I have up here is the tech bubble bear market here. It took, this was August to about 6 months to get into that textbook bear market definition territory. And boom, just in very short order, we had a 50% retracement. I'm sure people thought, okay, time to buy. This has to be the bottom. And, it was the bottom for, about 6 months. Remember, these bear market rallies, and this time it took a while to dissipate, can go for weeks and months. And then we broke through that line and then established a new low and then had a whopping 21% gain. Again, remember, I've explained that when everybody is short because they're thinking bear market's going to get worse, and then you get a little good news, an announcement or something, and all of a sudden these shorts cover and the market goes to the moon. So that held, from that peak right there in December, you go out another 3-4 months, and 3 months we'll call it, before it finally rolled over again, rolled over hard, and then boom, 21% gain, and a lot of people got sucked in only to roll over one more time, and then came out of it 21%, almost made a new bottom right there, but this was the end of that bear market in March of 2003, and we had a phenomenal run until late 2007. I won't show you that one this time, but again, I'd just be showing you very similar things, that if this is a bear market, these big, massive rallies to the upside that feel so good are largely the norm. And again, it doesn't mean we need to be stubborn and say, this is a bear market and there's no ifs, ands, or buts about it. We're not going to do that for sure. As the data change, if they do and they improve and it looks like maybe the bottom's been in, we will adjust accordingly. In fact, we did anticipate, and I think I told you this already in a previous video, we did anticipate this bounce. So while our put hedges were just screaming higher in value, we wanted to protect that value, so we bought some call options in here, and we largely mitigated the decline in the put. So our clients got to feel the lion's share of this rally in here, which was great. And that's because even though we're still thinking this is a bear market, there are ways that we can exploit big upswings when the technicals are telling us that odds are pretty high that we're going to get those. Looks like Monday could be one of those days. We'll see how next week unfolds, but I could see a pretty significant retracement. We could even come all the way back and test the all-time highs up in here before rolling over again. New all-time highs, I think that's a stretch. That's not our base case, but anything is possible. I will leave it there for now. And with so much going on, I'm sure you're going to hear from me quite a bit more often in the coming weeks. Thank you as always for watching and listening. Have a great day. Take care. Bye-bye.